Welcome to the NFT Finance Podcast, sponsored by Goldman Sachs. My name is Terry, and I'm once again joined by my co-host Helmus. Today, we welcome Joseph and Justin, co-founders of Astaria, an on-chain NFT lending platform.
Hey guys, welcome on, and thanks for joining us. I think let's kick it off just really high level. If you could do a little background on yourselves. Joe, why don't we start with you? What were you doing before crypto, and what got you into crypto and NFT specifically?
Well, when I got into crypto, I was in college. I had just gotten out of the Air Force, and I was following a lot of some of the the libertarian movements and Ron Paul, etc. And I got into Bitcoin when I found out about it and started mining it on university computers. And then I started to work at a bank, USAA, and then after a little while there, I just went headfirst into crypto, worked at Consensus, ETH2 Core Dev, and then Sushi, and then now Astaria.
Awesome. Yeah, thanks for that. And Justin, maybe a quick background on yourself?
Yeah, sure. So I've been in crypto since right about during the COVID crash. Before working in crypto, I was sort of finishing up my MBA here in Los Angeles at USC. And at the time I was working at Snapchat when everything with crypto was unfolding. And fortunately, I was introed to someone that was starting a business in the crypto space. So, at the time I hadn't purchased any BTC or ETH. And honestly wasn't too bullish on the space, but also wasn't too informed, but just wanted to work at a startup. So joined their team. That project is called Brink. And I would say they're building somewhat of a competitor to Gelato. They're building an automated transaction network. And then after that, I worked on the project NFT Finance as head of growth. So this was sort of during the 2022 bull market. We were providing liquidity as a service to different DAOs and new projects that had a new token. And so we grew the TVL up to, I think, 100 million by partnering with various stablecoin issuers and then DAOs that needed liquidity for their token. And in addition to all of that, and sort of through all of that, I created a YouTube channel that grew pretty well and allowed me to meet some great people. So, along the journey, I met Joe. I think we were talking about a sushi governance proposal, and we hit it off. And eventually, we met actually in Denver at ETH Denver and decided to start fundraising for Astaria and build this thing.
Oh, that's amazing. And then so whose whose idea was Astaria, and how did it come about? Was this something you guys were talking about before ETH Denver? Was it something you guys started ideating around then, or what was really the inception moment of Astaria?
Yeah, I would say, Joe's been the technical architect and sort of designed our systems. Actually, when we were fundraising, we were initially fundraising for a different concept. Joe can talk more about that after me, but we were initially looking at building a better Aave, let's say. We don't have to get too in the weeds, but we were looking at building a better traditional lending market. And I think down the line realized that the technical lift to do that would be very challenging. And also that the gains or the impact on the market wouldn't be that significant. Sure, maybe we can bring interest rates down a little bit, but it wouldn't have the same impact as an NFT lending market. In our view, a truly successful and efficient NFT lending market, which is what we're going after with a sort of more unique design. But I'll pass it over to Joe to talk through his technical process.
Yeah, initially we had targeted lending markets, and we were planning to increase capital efficiency through using synthetics to lend, not the proper noun, but synthetic tokens. And as we were going and iterating in this design process, because we built some of it, we built a simulator, and we realized that the technical lift and the time of the development cycle was going to be super high, like a year plus maybe to get like just to prod the first time. And so we started to like reevaluate that. And then also the other thing is the design is not that exciting. Me and Justin Justin said the best we wanted to do is 0 to 1. And what we were doing was kind of pretty iterative, really derivative, not that exciting. And I think for the design for Astaria that we have now, we started from the premise that NFT lending is kind of miserable right now for lenders, borrowers, and we wanted to kind of like do a fresh start because there's a lot of protocols out there that are doing NFT lending. We wanted to make one that was really easy for borrowers and lenders to both use.
Cool. So no, I think this is a perfect segue into like maybe what is Astaria? So why is, I guess, like Astaria to you guys a 0 to 1 in the NFT finance space?
So we designed a new system. So we first started, I guess, backing up a little bit. How I had said that we wanted to improve NFT lending, which was miserable at the time. And I think one of the other things that I was focused on was efficient liquidations or systems where collateral needed to be liquidated, that it could be because NFTs by their nature are relatively illiquid, a system that was kind of safe for liquidations. And we'll see a lot of different designs out there that include like oracleization and floor prices, which I wasn't super keen on oracles. Oracle risk is always a hard problem to solve, as well as I really liked some of the other lending protocols. I liked their design that had like couture valuations for the asset, and we wanted to kind of like combine those two, like a peer-to-pool system and couture valuations. And so I think we iterated really the first time we had something that was okay. And then the second time we built that was the core idea of what Astaria was now. We designed something called the 3-actor model, the 3 a.m., which is, if you'll look at some of the lending markets now, they are that are peer-to-peer. You have to have a lender that has expertise about the asset that they're lending to, and then you also need, and then there's like the borrower, right? So the lender has like kind of like this double duty, and the borrower is just kind of like borrowing. Also, there's this back and forth conversation that's like asynchronous in some ways, like a negotiation about the terms of the loan, which I didn't think was an ideal user experience either. And so so we split the lender, what is lender in another system to be a liquidity provider and a strategist. And the strategist is providing terms to a pool, and a liquidity provider provides liquidity to that pool. And the borrower borrows from that pool with having terms already set before they arrive. And they can just directly borrow from the moment they come to borrow against their assets, which I think is ideal to separate the strategist and the liquidity provider. It's kind of like separating, a knowledge worker from capital. and the strategist really acts as like an oracle for terms for these liens.
Yeah, that makes sense. And I guess like based on your model, so if I'm a strategist coming in, I have like deep expertise on NFTs, how to value them. I guess I come to use Astaria. I can create a vault. And I guess like can anyone go in and create a vault, and how does that kind of work?
Yeah, so there, I guess there's a couple ways to answer that question. The first would be, I'll just tackle the first one first, or the second one first, rather. Anyone can create a vault, but for launch, we're working with what we call our like trusted or approved strategists to create the first public vaults. Now, that said, anyone can create what we call a private vault. This basically means that anyone can spin up a vault, but we're just not going to highlight it in our UI. But for folks we've been working with, there's probably about 12 or so companies in this space that are building these professional appraisal engines to build these strategies. And all of those companies are going to be approved at launch, so they can post strategies. Everyone will see them on our UI. But of course, if you're just an individual and you're an expert in the NFT space, you can create your own vault. You'll have a custom link generated, and then you can send that link out, let's say on Twitter, to your friends, etc. And you'll be able to see it in our UI and contribute capital. We just won't sort of bubble it up to the top as a featured strategy vault.
And how does the user experience work for both, like I guess like the LP and the borrower as well?
Yeah, sure. So yeah, great question. I mean, we're trying to build this, flywheel, so to speak, where all the parties work together seamlessly. So the strategist sets up this vault. The vault has, any number of terms. It could be they're appraising 10 NFTs, they're appraising 10,000 NFTs, as many or as few as they want. And then the lender comes along and they come to the platform and they look at different vaults, and maybe they really like Goblin Sachs, or maybe they really like Upshot, or maybe they like Deep NFT Value, for example. And they start looking at the methodology of these vaults, what the vaults have done historically, what their historical returns are, what their historical lending rates, and they can say, you know what, I really like the Goblin Sachs vault. I'm going to contribute my 10 ETH to this vault. So the lender lends that 10 ETH into the vault, and then now the borrower can come to the platform. They're looking at the Goblin Sachs vault. They see, oh, my CryptoPunk was appraised by Goblin Sachs. There's liquidity in this pool or in this vault. I'm going to borrow that instantly and get that instant liquidity. And so this is basically marked at the vault level. And then, of course, when the terms are up, everyone that contributed to that vault had a share token, which represents ownership of the vault. And so when there's successful debt repayments to the vault, that gets credited to the shares. And of course, if there's any losses, that gets aggregated to the share level as well. So when you provide liquidity into a vault, you're sort of buying a piece of all possible loans that the vault has appraised, if that makes sense.
Yeah, that's great. And then just curious, so I know like different like lending platforms offer different collateral support. So do you guys like, so I would imagine you support PFPs, but do you guys also support any other type of NFTs like like Uniswap, like LP positions? Yeah, just curious if you guys support those as well.
Yeah, it's a great question. It's something we're really excited about and really pushing for. Of course, we're excited about the PFP space, but we're also excited about what NFTs can be beyond even just art, simply because most of the world's value is non-fungible. And if we think most of the world's value is coming on chain, that's kind of the place we want to be. So, to that end, at launch, we'll be supporting, as you mentioned, Uniswap v3 positions. So strategists can write terms for different token pairs and ranges on Uniswap v3. And if you fit into those buckets, you can borrow instant liquidity against it, which we're really excited about. And then we're also doing a pilot program with Liquidity, if you all are familiar with their Chicken Bonds platform. It's effectively like a stablecoin value accruing NFT that uses the Liquidity protocol to drive value to it. And so we'll be providing loans against chicken bonds, which is exciting for us because, they're very low risk, they're stablecoin denominated. And so they're going to allow people to get, a loan against a value accruing stablecoin position, which also is similar to UniV3 as well.
Want to dive deeper into the strategist role and especially like vault risk parameters. Specifically, what parameters do strategists get to control?
So strategists get to control the assets that will be used as collateral. They also get to set the terms of the loans. They have the terms of loan might mean amount, duration. Amount and duration are the big ones, rate, etc. And then, they have kind of like full control. They're acting as an oracle for the vault. And so they choose what gets lent to and what doesn't.
Gotcha. In that case, how do you curtail, say, like a strategist's power? Like if they get full oracle control over the valuation as well as the terms, like could they not induce liquidations?
So our lanes are fixed rate, fixed term. So they can't they can't induce a liquidation. However, there are some attack vectors. Notably, they have full control over what assets get lent to and the amount, which is more than enough to be malicious. And so generally, it's going to be a reputation-based system with our where anybody can create a vault, but the ones that we kind of bubble up into our UI for liquidity providers to provide liquidity are essentially the strategist that we've partnered with.
Gotcha. That makes sense. Like from the perspective of a strategist, how do you balance, say, like the granular reaction speed to new market developments and just the accumulating gas costs that might exist from operating like a vault with a large support of different assets, different terms, and things like that?
I'm really glad that you asked that. That's a great question. So we have vaults are on chain, but data availability is off chain. So what that means is a strategist can create terms for a vault that goes into a Merkle tree, and then they sign a root of a Merkle tree. And then they push their terms out into IPFS. Those terms can get collected, and Merkle trees are a way of kind of proving that something inside the tree is valid. In this case, it's lien terms. And once the root is signed, that can't be forged. And so what happens is this all happens behind the scenes for the user, but a signed root is presented to the contracts that's matched with the vault owner, and then a Merkle branch proving that the terms, which would be the conditions for the new lien and the collateral, are presented to the contract, which then become validated against the same root that was signed. And then the user is able to provide their collateral and take a new lien.
Gotcha. That makes a lot of sense. So I guess for the strategist perspective, the extent of gas costs for updating, every single lien term and asset term for all the NFTs they underwrite would be simply, posting the Merkle root on chain.
So they don't even have to post the Merkle root. Just they have a delegated signer, and that signer just has to sign the root, and the root can be provided by the end user. So they can publish new terms every second if they want to, without having to make a transaction. Each set of terms comes with an expiration, like a time to live. If you're like Like if you think of it in terms of like internet traffic, there's like a time to live on the terms, and then also assuming that you produce, like let's say that they produce terms that they're not comfortable with, or the market has shifted, there's also a system to increment their vault nonce, which will invalidate all of the other terms.
And let me shift gears a little bit. If we could talk about from the perspective of the borrower. So if I'm wanting to borrow against one of my, like, let's just say like a gaming NFT, is it possible for me to kind of like retain the utility of that?
Yeah, absolutely. So it's a good question. And Joe can talk more on the technicals as well, but we built in a mechanic that we're calling flash actions. And with a flash action, like as long as the NFT that you've borrowed against can return to the vault in the same transaction, you're allowed to pull it out to, let's say, with Bored Apes, claim the ape token. So you would do this flash action, the NFT would get pulled from the vault in the same block, you would claim the ape tokens, and then it would return right into the vault to make sure that you're safely collateralized. From my understanding, it's a bit of a manual process in that we have the general feature for flash actions implemented, but we'll have to sort of create the action, or the community will have to create the action on an as needed basis. So one example would be that we're actually working on ourselves is Uniswap v3 fee claims. So your Uniswap v3 NFT will, continue to accrue fees for the life of its position as long as it's in range. And of course, we want users to be able to claim those fees. So at any point, your Uni v3 position is collateralized, you've borrowed some ETH against it or some stablecoins against it. You can do this flash action to then take your fees out of the position, realize those fees, and then maybe you want to use that to pay down some of your debt, or you're just using that as, let's say, income.
Cool. And then curious. So as far as like, let's say I wanted to kind of like extend the duration of my loan. Is that possible from like the borrower? And if so, like what does that look like, and how does that work?
For the borrower, you're able to extend the loan, assuming there's somebody that will, write terms that make a repayment on your loan. And then also we have another mechanic we call permissionless refinancing, which allows kind of anybody to refinance any loan just on the basis that you provide better terms. And so you kind of have to beat the existing interest rate and extend the lien.
Yeah, I also want to add on here because we get a lot of follow-on questions like, well, how can you, without talking to the borrower, permissionlessly refinance them? And as Joe said earlier, the way we do that is anyone can buy out anyone else's debt as long as the borrower is getting better value or better terms. So if you've borrowed 10 ETH at a 10% rate, at any point, someone can then say, you know what, this is a really safe piece, or the value of the piece has gone up, or whatever the reason may be. I'm going to now lend them 11 ETH at, let's just say, a 9% interest rate. So as long as they're beating the existing terms that the borrower agreed to, the borrower can be refinanced. And it's really great for all parties because the initial loan originator gets a small fee for originating that debt. The new lender gets that new interest rate that they agreed to. And of course, the borrower gets better terms. So in our view, this is just sort of a win-win for all parties here, where everyone on our system should theoretically be getting the most competitive rate in the market possible.
Yeah, it sounds like it creates like an interesting price discovery mechanism for the NFTs. Curious around like liquidations. I know we touched on it a little bit, but could you guys provide just an overview of how that works? I assume liquidation occurs if the loan is not repaid. Yeah, I guess like just a little more color around that would be great.
Well, once the term has expired for the lien, there is a liquidation process gets triggered. Like I mentioned earlier, it's fixed rate, fixed term. So your interest rate stays the same the entire time. And your term is, has a has an end from the time that you open it. And when that ends and there's a positive balance, it goes to liquidation, which we do through a Dutch auction. So we set like a starting price above the amount that is owed. And then that continues to decline until that amount continues to decline until it gets a bid, and at the time that it's bid, it then kind of like closes out and finalizes all the liens that were taken against the NFT.
Awesome. And then just to zoom out a little bit, guys, and really, I guess like this is a question for both of you. How do you guys see like NFT finance progressing really over the next 12 to 24 months?
I think more utility in terms of like what the NFTs are. And I don't, by utility, I don't necessarily mean like, NFT staking. I think the addition of real world assets is one that we've talked a lot about. I think Uni V3 is a great example of an NFT that has some inherent intrinsic value to it, makes it great collateral. And I think that we're going to see in the coming year, at least, we're going to see an explosion of real utility for NFTs, like the same way we saw, kind of the 2017, we saw this like big upswing in token launches, and then in 2020 we saw kind of like real utility come to those tokens.
Yeah, and then for me, I could be totally wrong in this, but I personally think sort of the boom of the traditional NFT collection that we've seen over the past year or so, or maybe year plus, where you're just minting a 10,000 piece PFP collection. I think it's pretty clear to me that the boom of that is over, and that, in my view, the next NFT boom won't be the way we traditionally view of NFTs. So I personally don't think, if we have another bull market or when the bull market returns, that's what's going to be popular. I think we're going to see use cases we couldn't even think of in the NFT space. And of course, as Joe pointed out, more real world value on chain represented as NFTs. Throughout this process, we've been able to, we've tried to talk to anyone that's wanted to talk to us that's building in this space. And we've been able to talk to a lot of people that are building very unique projects where they're trying to build a way to bring certain or very specific real world assets on chain. Of course, there's, centralization risks there, but still very interesting space. And yeah, that's what I'm most personally excited about in the NFT space, is bring these real world assets on chain. And although I am, of course, very excited in the art, I think that is just really the tip of the iceberg for NFTs. I think NFTs can be so much more than just art.
Awesome. Yeah, we definitely agree on the thesis there. Are there ways to get involved in the project? If so, how?
Yeah, I would say we're always looking for great people. So if you're an extremely talented engineer, specifically on the smart contract side of things, please reach out, or just reach out and share your GitHub, and we're happy to chat and learn more. If you're potentially interested in becoming a strategist, if you're building an appraisal engine, if you've been successful on existing platforms like NFT please reach out. We're happy to chat with you. And then we're also doing a little matching, gearing up to a launch of strategists and lenders. So if you're a large liquidity provider, potentially reach out to us and we can introduce you to any of our strategists or all of them. You can get a sense for their methodology before launch, and then we'll all be in a good place to sort of work together to launch successfully, ideally in the new year.
Awesome. Thank you, Joseph. Thank you, Justin, for your time. And folks, go check out Astaria at Astaria XYZ on Twitter.
Thank you so much.
Perfect. Thank you.
Follow me on Twitter. I'm 0xTayTayHoHo on Twitter. That's Tay with an E. And you can follow Ryan at _Helmass.
Yeah, and that's _HELMASS. Thanks everyone for tuning in, and we'll catch you soon.